Hey there, welcome to the North Florida VA Real Estate Podcast. I'm Darian's avatar, the voice he sends out when he's managing real estate clients, working hospital shifts, and refereeing karate matches in the living room between his two daughters. And somewhere in there, he's still trying to convince himself that golf is relaxing. If this is your first time using your VA loan, or if you're thinking about buying your first home soon, this episode could save you thousands of dollars and years of trial and error. So go ahead and download this episode now so you can come back to it later. And if you have a battle buddy who's thinking about buying, send this to them too, because the right information at the right time makes all the difference. Let's get started. Today, we are tackling a topic that is the ultimate end state for every veteran homeowner. We are talking about the debt-free dream. Specifically, how you can slash years, literally a decade or more, off your VA loan without needing a lottery win or a massive inheritance. I want you to close your eyes for a second and imagine a life where your BAH isn't going to a landlord or a bank. Imagine a life where your monthly housing cost is simply property taxes and insurance. In North Florida, for a typical home in Orange Park or St. John's, that might be $400 or $500 a month. Compare that to a $2,800 mortgage payment. That $2,300 difference is your freedom. That is the debt-free dream. But most veterans never get there. Why? Because the system is designed to keep you in debt. When you sign that note at the closing table, the bank is handing you a 30-year schedule. They want you to take all 360 months to pay it back. Why? Because that is how they maximize their profit. Let's look at the truth in lending math for 2026. If you buy a home today for $450,000 at a 6.1% interest rate, which is where we are seeing VA rates hover right now in March, your total interest over 30 years will be roughly $532,000. You are paying for the house, and then you are paying for an even more expensive house just in interest to the bank. My mission today is to show you how to keep that $532,000 in your pocket. We are going to dive into the why and the how of predatory amortization and how to break it. First, let's understand the enemy, the amortization schedule. Amortization is the process of paying off a debt over time through regular installments. But in the mortgage world, it's heavily front-loaded. In the first 10 years of your 30-year loan, almost 80% of your payment is going toward interest. You aren't building equity, you are just renting the money. If you want to win, you have to attack the principal balance early. Every dollar you pay toward the principal today stops the interest from compounding on that dollar for the next 20 or 25 years. It is a massive force multiplier. Strategy number one is the biweekly payment strike. This is the simplest move in the book. Most veterans get paid on the 1st and the 15th, but your mortgage is a monthly bill. By switching to biweekly payments, you pay half of your mortgage every 2 weeks. Because there are 52 weeks in a year, you make 26 half payments. That equals 13 full payments instead of 12. You just tricked the bank into accepting an extra month's payment every year. In a $450,000 loan scenario, this single move shaves about 5 to 6 years off your loan. It turns a 30-year mortgage into a 24-year mortgage without you ever having to change your lifestyle or skip a meal. But here is the legal and logistics warning. You cannot just send 2 checks a month and expect it to work. Most loan servicers will just hold that first half payment in a suspense account until the second half arrives. They don't apply it to the balance until it's whole. To make the biweekly strategy work, you often have to sign up for a specific program through your lender, or you have to manually calculate 1/12 of your payment and add it to your monthly check. Let's talk about the principal sniper method. This is for the veteran who wants to be aggressive. I want you to look at your monthly statement. You'll see a line item for principal and interest. In the early years, the principal might only be $600. The sniper move is to send an extra payment that matches exactly 1 month's worth of principal. If you do this just once a quarter, 4 times a year, you aren't just saving 4 months. Because you removed that principal balance, you also removed all the interest that would have been calculated on that balance for the next 2 decades. One extra principal payment per quarter can cut 8 to 10 years off your loan. In North Florida, we have a unique advantage with our property tax exemptions. If you are a veteran with a disability rating of 10% or higher, you are eligible for certain exemptions. If you are 100% P&T, permanent and total, you likely pay zero property taxes in the state of Florida. Too many veterans take that saved money and spend it on a new truck or a boat. I want you to take that tax savings and reinvest it into the principal of the loan. If your property taxes were $400 a month and the state of Florida just gave you that money back because of your service, send that $400 right back into the mortgage principal. You were already prepared to pay it. Keep paying it, but pay it to yourself, not the county. This is the fastest way I have ever seen a veteran pay off a home in Clay or Duval County. Now let's talk about the 15-year refinance trap. In 2026, you will see a lot of mailers telling you to refinance into a 15-year loan for a lower rate. On the surface, it sounds great. 15-year rates are usually about 0.5 to 0.75% lower than 30-year rates. But here is the danger. You are locking yourself into a mandatory, much higher monthly payment. If life happens, if you have a medical emergency, if the car breaks down, or if you have a gap between jobs during a PCS, you must make that high payment or risk foreclosure. Instead, I recommend the Ghost 15 strategy. Keep your 30-year VA loan. This gives you the safety net of a lower mandatory payment. But use a mortgage calculator to see what a 15-year payment would be at your current rate. Then pay that amount voluntarily. You get all the speed of the 15-year payoff, but if things get tight, you can drop back down to your 30-year minimum without asking for permission. You keep the control. Let's dive into the VA funding fee logic. If you are using your VA loan for the second or third time and you aren't 10% disabled, you are paying a 3.3% funding fee. Most veterans roll this into the loan. On a $500,000 home, that's over $16,000 added to your debt on day one. If you want to pay off your loan faster, you need to attack that fee first. If you have the cash, pay the funding fee at closing instead of rolling it in. If you can't pay it at closing, make it your mission to kill that $16,000 balance in the first 12 months. Until that fee is gone, you haven't even begun to pay for the house itself. I want to tell you a story about a client we worked with in Green Cove Springs. Let's call him Marcus. Marcus was an E7 getting ready to retire. He had 5 years left in the Navy. He bought a home and decided he didn't want to carry a mortgage into his civilian life. Marcus used what we call the windfall weaponization strategy. Every time Marcus got a tax refund, every time he got a re-enlistment bonus, and every time he had a 3-paycheck month, which happens twice a year if you're paid bi-weekly, 100% of that found money went to the principal. He also did something most people find radical. He took his annual pay increases and his BAH increases and never saw them in his bank account. He set up an automatic allotment so that the increase went directly to the mortgage servicer. He lived on his E6 pay while he was an E7. By the time he retired, his $350,000 mortgage was down to $40,000. He paid off the rest with his final separation pay. He started his civilian career with a 100% equity position. Think about the psychological shift that happens when you don't owe anyone a dime for the roof over your head. Your risk tolerance goes up. You can start that business you've always wanted. You can take a lower paying job that you actually love. You can spend more time at the karate studio with your kids because you aren't chasing the next $3,000 just to keep the lights on. Let's talk about the rounding up habit. This is for the veteran who wants a low effort snowball. If your mortgage payment is $2,243, pay $2,500. It's an extra $257. To many people, that's just a few dinners out or a couple of rounds of golf. But that $257 a month over the life of a VA loan will save you roughly $85,000 in interest and cut nearly 7 years off the back end. In North Florida, where the cost of living is rising, future-proofing your housing is essential. By paying more now, you are insulating yourself against future inflation. A dollar today is worth more than a dollar 10 years from now. Use today's stronger dollars to kill tomorrow's debt. Now, I want to address a very specific technical detail, the recast myth. A lot of civilian loans allow you to recast if you pay down a large chunk of principal. They recalculate your monthly payment to make it lower based on the new balance. The VA does not officially support recasting in the same way. If you dump $50,000 into your VA loan today, your monthly payment will stay exactly the same. You won't see any extra cash in your pocket every month. You'll just see the end date of the loan move closer. If your goal is to lower your monthly payment now, you have to refinance. But as we discussed, refinancing resets the clock and costs money in closing fees. This is why the debt-free dream requires a different mindset. You aren't looking for lower monthly payments. You are looking for no monthly payments. Let's look at the opportunity cost. There are financial advisors out there who will tell you, Darian, don't pay off a 6% mortgage. The stock market returns 10% on average. You are losing 4% by paying off the house. On paper, the math works, but paper doesn't account for reality. The stock market return of 10% is not guaranteed. It can be negative 20% next year. Your mortgage interest of 6% is a guaranteed cost. By paying off the loan, you are getting a guaranteed 6% return on your money, tax-free. Show me another investment that offers a guaranteed, risk-free, tax-free 6% return in 2026. It doesn't exist. Furthermore, you can't live in a 401k. If the world goes sideways, you can't move your family into an index fund, but you can live in a paid-off house. For a military family, security is more than just a word. It's a lifestyle. Let's talk about the exit strategy for a paid-off home. Once you hit that zero balance, you have options that 99% of the population will never have. The pure cash flow rental. If you decide to move, you can rent that house out. In North Florida, a $450,000 home might rent for $3,000. If you have no mortgage, that $3,000 minus taxes and insurance is pure profit. That is a legacy engine for your kids. The HELOC leverage. You can take out a home equity line of credit against your 100% equity. You can use that free money to buy your next investment property for cash, negotiate a better deal, and repeat the process. The downsize flip. You can sell the big family home and buy a smaller retirement condo at the beach for cash. You move from a debt-free dream to a debt-free reality at the ocean. Here is your 4,000-word action plan for the next 30 days. Step 1. The paperwork recon. I want you to go to your blue folder or your digital closing docs. Find the amortization schedule. If you can't find it, go to your lender's website and look for loan details or projected payoff. I want you to look at the interest versus principal breakdown for your next payment. Write those two numbers down on a sticky note and put it on your fridge. That is your motivation. Every month, you want that principal number to get bigger and that interest number to get smaller. Step 2, the 1/12 calculation. Take your monthly principal and interest, P&I amount, divide it by 12. If your P&I is $2,400, 1/12 is $200. Starting next month, add exactly that amount to your payment. Mark it principal only. Congratulations, you just cut 5 years off your mortgage. Step 3, the audit of the hidden money. Look at your LES. Leave an earnings statement. Look at your disability pay. Look at your tax withholdings. Are you getting a $5,000 refund every year? That means you are giving the government a 0% interest loan while you are paying the bank 6% interest. Adjust your withholdings so you get that money now and send it to your mortgage principal every month. Step 4, the North Florida Advantage. If you live in Florida, check your homestead exemption. If you are a veteran, make sure you have applied for the additional veterans exemption. If you are 100% disabled, make sure you have filed for the total exemption. Once that is approved, your escrow account will have a surplus. The bank will send you a check for the overage. Do not spend that check. Send it right back to the bank as a principal reduction. Let's talk about the emotional battle. Paying off a house is boring. It's not exciting like buying a new car or seeing a stock go up 20% in a day. It is a slow, steady grind. There will be months where you want to skip the extra payment and go on a fancy vacation. When that happens, I want you to think about the wealth gap. The difference between a veteran who retires with a mortgage and a veteran who retires without one is usually over $1 million in net worth over a lifetime. You are choosing between a temporary want today and a permanent freedom tomorrow. I want to talk to the spouses for a minute. You are often the chief financial officer of the household. You see the bills, you manage the budget while your partner is deployed or on shift. You have more power than anyone to make the debt-free dream happen. When the extra money comes in, be the one who says, "Let's put this toward the house." Be the one who tracks the progress. Celebrate the milestones. When you hit 50% equity, go out to a nice dinner. When you have only 10 years left, have a party. Make the journey visible. In the North Florida veteran community, we are stronger when we are financially independent. When we aren't beholden to the banks, we can invest back into our communities. We can support our local VSOs. We can mentor the next generation of service members. This podcast is called North Florida VA Real Estate for a reason. We aren't just talking about houses. We are talking about the dirt you stood on to defend this country. You earned the right to own it. Not to lease it from a bank for 30 years, but to own it. If you have questions about your specific loan, or if you want to see a payoff roadmap tailored to your rank and your time in service, reach out to us at Exit Inspired Real Estate. We have the tools to show you exactly how many days you are shaving off with every extra dollar. We serve those who serve. And that service doesn't end at the closing table. It ends when you burn that mortgage note. As always, everything you want is on the other side of fear. The Florida Veterans Real Estate Podcast is brought to you by Exit Inspired Real Estate. All information is for educational purposes. Consult a professional before making financial decisions. Equal housing opportunity.